Now, when the market has a splendid week like this past week, it can be tempting to want to go all in on the winners. But we must continue to be disciplined in our diversification and our long-term investing strategy. Good morning and welcome to Life in the Markets. My name is Stephen Rohr and I am a wealth manager here at the Life Financial Group. It was a sublime morning coming into work this morning here. To go along with a beautiful morning, it was a beautiful week in the markets, at least as far as the returns go at the end of the week. It really was just a feel-good week by the end. The S&P hit a new record high. It is up 4.66% as of week to week there, which makes 13.32% year to date. The equal weight was up 3%, and that makes it up 14.89% on the year. So the cap weighted has caught up a little bit with the equal weight because some of the major tech names had a great week. So for instance, SpaceX, they recovered a great deal of the losses that they had, and they're almost back up to their high of $135 per share. Because of that, the NASDAQ, tech heavy, was up 5.67%, which makes 22.57% on the year. Russell 2000, almost as good year to date as the NASDAQ, was up 3.32% week over week and 22% year to date. Now, the international picked up a good bit last week, being up 4.97%, which makes it up 13% on the year. Gold and silver picked up again last week after a long stretch of declines. So gold was up 7% and is at $4,341 per ounce. Silver was up over 9% and brings it to $63 per ounce. Still down almost 13% year to date. Gold is just about flat year to date. Oil, however, went down, which is excellent. Went down 14.49%, down to $77 a barrel. Bitcoin was up just a little bit. Bonds, the AG, was up almost nothing, 0.13%. So basically flat there, and similar for the HYG bond. Now, the 10-year Treasury, again, almost flat, down just a little bit at negative 0.7%. Now, the good news is there are some fundamentally good reasons for why the market is positive this week. So what are these reasons? Initial jobless claims stayed low, with the 4-week average dropping from 203,000 to 199,000. Not much, but positive, good direction. And about 100,000 less year over year of continuing jobless claims. Robust earnings reports across a substantial breadth of the economy have been released. So, of the Q2 earnings reported, the vast majority of companies improved their earnings per share. Almost 87% of the companies, in fact, improved their earnings per share. This is very unusual. In fact, it is the highest rate of improved earnings per share in 5 years. Top-line revenue was also well improved across all the reports. 77% reported improving their top-line revenue. For a brief refresher on the difference between the two, earnings per share measures the bottom-line net earnings, where top-line revenue reflects gross sales. So, earnings per share can be improved by increasing the efficiency of the operation or decreasing costs to manufacture, to sell, etc. But top-line revenue growth, on the other hand, that indicates that more dollars are being spent or that sales have picked up in general. So for both to be up almost the same amount is a good sign across the board. However, there were some negative news. In July, companies laid off more employees than they hired for a net negative of 23,000 jobs. This was quite the drop from expectations because it was expected that companies would add a net 83,000 jobs in July. However, for the investing world, this was weirdly positive news because it lessens the likelihood of a Fed rate increase later this year. The overall unemployment rate actually ticked down a little bit this past month. That means if there were less jobs added and still lower unemployment numbers, it means more people have left the workforce. And we can see that the overall workforce participation rate is at the lowest it's been in quite a while, and again, some years. Now, there are some potential hidden negatives as well that aren't quite so obvious, but I think bear referencing and being careful of. Much of the corporate incentives for the CEO and C-suite these days are structured around quarterly earnings. The incentives are so strong to improve quarterly earnings and beat the earnings estimated return. This may be encouraging corporate decisions that are actually bad for the long-term good of the company. Things like outsourcing or hiring H-1B visa employees may look better on the profit line for a few quarters, but ultimately may be undermining the strategic strength of the company by either exposing the company to the risks of foreign entanglements with outsourcing key departments potentially, or with the very different employee culture and mindset, and even fraudulent certifications and diplomas. So in case you haven't heard of the H-1B visa, it is not for geniuses. There is a separate visa for really rare intellects. H-1B visas are supposed to be for high-skilled but comparatively normal jobs like IT and computer programming. American companies are only supposed to be hiring via the H-1B visa if they cannot find qualified American applicants. This can be circumvented by posting job openings in obscure places like newspapers or by finding problems with U.S. applicants. Over 70% of these H-1B applicants come from India. Now, Kayleigh McEnany reported on Fox News that an investigation has found a number of institutions in India were creating fake diplomas and certifications. To quote her, "Law enforcement in India claims it has uncovered a network of universities that produce fake degrees which were possibly used to obtain these high-skilled H-1B visas, including one school which allegedly stole over 36,000 fake degrees. It cost as little as $1,400 for one of those. And while these are supposed to be high-skilled employees during almost all of Biden's time in office, 83% got junior or entry-level positions," end quote. Now, because of that, Texas Attorney General Ken Paxton has initiated investigations against companies for fraudulent use of H-1B visas. So part of the hiring and laying off situation that we've been seeing the numbers on, the H-1B visas may be skewing some of the positive hiring numbers, because they're laying off American employees who cost more and are hiring cheaper H-1B visa employees. President Trump issued a proclamation in September of 2025 announcing an additional fee that must be paid to hire one H-1B visa applicant. In his words, these H-1B visas pose a national security threat by discouraging Americans from pursuing careers in science and technology, risking American leadership in these fields. This can help to remove some of the incentives for businesses, as they can usually pay an H-1B employee substantially less than an American is willing to work for. In addition, employers or bosses are often able to leverage this visa tenuous situation that they're in against them and pressure them to work extremely long hours that an American citizen would perhaps not be willing to do. In other news, a lawsuit against Meta in New Mexico produced a court order that Meta must establish a $567 million fund to compensate those who have been hurt by social media. This is specifically in regard to Meta's lack of provisions to protect children from dangers of social media. Now, what to look for this week? On Wednesday, CPI numbers will be released for the month of July. With the ups and downs of oil prices in July, it will be fascinating to see what effect there will be, if any, as far as the immediate effect goes. I suspect that July's CPI numbers might be down a bit as a lagging effect of the oil prices declining through the months of May and June and part of July. Now, there will be more quarterly earnings reports released this week. In addition, on Friday, July's numbers from both the Census Bureau's retail sales data and also the University of Michigan's consumer sentiment and expectations will be released this week. What lesson can we be reminded of this week? Now, when the market has a splendid week like this past week, it can be tempting to want to go all in on the winners. And when there are substantive, good economic indicators, it can be doubly enticing to throw caution to the wind. But we must continue to be disciplined in our diversification and our long-term investing strategy. King Solomon reminds us of this principle. In Ecclesiastes 11:1-6, Solomon says, "Cast your bread upon the waters, for you will find it after many days. Give a portion to 7 or even to 8, for you know not what disaster may happen on earth. If the clouds are full of rain, they empty themselves in the earth. And if a tree falls to the south or to the north, in the place where the tree falls, there it will lie. He who observes the wind will not sow, and he who regards the clouds will not reap. As you do not know the way the Spirit comes to the bones in the womb of a woman with child, so you do not know the work of God who makes everything. In the morning, sow your seed, and at evening, withhold not your hand. For you do not know which will prosper, this or that, or whether both alike will be good." As this passage reminds us, we must continue with steady work on what God has put before us, planting and sowing, diversifying our investments, and then trusting God to bring the increase and to prosper things according to His sovereign will. We hope this was an encouragement to you this week as you reflect on the market happenings in light of biblical principles. Please share with those who you may find this to be useful, and we will look forward to meeting with you again next week. Thank you.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. All information herein is from sources believed reliable, but is not guaranteed for accuracy or completeness. The team assumes no liability for any errors, omissions, or actions taken based on this material. Information is as of the date stated and subject to change without notice. Securities and advisory services offered through Genius Wealth Management. Member FINRA and SIPC.